8. Bank credit. Tribution. Every new labor-saving device introduced has involved an increase in capital needed in the line in which that device is used, relative to the amount of liquid or short-time funds required. Point 1. In one sense, continuously floating paper, when marketed by note brokers, is liquid, and in another it is not. From the standpoint of an individual bank, it is ordinarily very liquid, although in times of crisis the makers might experience difficulty in meeting their obligations. From the standpoint of the banks taken as a whole, this paper, put on the market by brokers wherever buyers among banks can be found, is distinctly non-liquid. From the standpoint of the borrowing concern, the floating of paper continuously in the market is almost tantamount to the issue and sale of bonds. From the standpoint of the banking system, the floating of such paper is also almost equivalent to the sale of bonds to the banks, but from the standpoint of the individual bank, the short-time paper is liquid and mobile. In an ideal bank credit situation, continuously floating paper would not be outstanding and borrowers would completely pay their obligations to banks at least once a year. The business or trade that has a season longer than a year is rare, perhaps non-existent. At the same time, some lines of business, like that of the tanner, whose vats, always filled, impel him to borrow money every day in the year, are non-seasonal, and yet make heavy demands upon the loanable funds of banks. There is no good reason in such cases why banks should not lend, provided the ratio of quick assets to current liabilities is adequate. The Introduction. 9. Capital or net worth of the borrower ample, and the other elements in the situation favorable. What the commercial banker ought assiduously to avoid, even where loans are based on time deposits, is the unliquid condition of the loan item that exists when his funds are invested heavily in fixed form, in real estate, equipment, etc. Repayment then becomes a matter not of days or months, but of years, and may be extremely uncertain. In succeeding chapters we shall consider in detail the nature of the process involved in the manufacture of bank credit, the relation of loans to other magnitudes in the balance sheet in both individual and collective banking, the recent evolution of our bank credit arrangements, the basis of bank loans, and the influence of certain institutions and practices upon the quality of the contents of the banker's portfolio. A brief study of banking operations and accounts, designed to make clear the nature of commercial banking, is given in the next chapter as an essential preliminary to the development of principles attempted in the pages that follow. Part I. Quantitative aspects of bank credit. Chapter 2. The nature of commercial banking. The lending functions of a commercial bank are so radically different from those of the money lender, putting out only his own funds, that it will be desirable at the outset to consider carefully the nature of banking, the essence of which consists in the practice of extending loans far in excess of either the capital or cash holdings of the bank in question. A glimpse of the difference between bank loans and the loans of a money lender will be gained if we examine the balance sheet of a bank as the institution expands on the basis of the cash paid in by the shareholders in exchange for shares of stock. Banking transactions and accounts. Following the customary practice of setting down the assets and liabilities on opposite sides of the balance sheet, we note first that the payment of, say, $100,000 capital stock, 1,000 shares of $100 each, will result in the creation of assets and liabilities as follows. Assets. Liabilities. Cash $100,000, capital stock $100,000. The balance sheet shows cash as an asset, debt, paying power, and capital stock as a debt. Sometimes, capital stock is shortened to capital, in 13. 14. Bank credit, which case the reader may have difficulty in bearing clearly in mind that capital really means, not the cash paid in by the shareholders, but what the bank as an institution owes the shareholders on account of their cash contributions to the enterprise. Capital stock or capital is always a liability of the bank. It would be natural for many of the shareholders to transfer their accounts from older banks to the new, and we may suppose that cash amounting to $50,000 is deposited by shareholders. The balance sheet or financial statement will then read: assets, liabilities, cash $150,000, capital $100,000, deposits $50,000, $150,000, $150,000. Local businessmen, friendly to the promoters of the new bank, also open accounts, depositing $5,000 in cash and $20,000 in checks on other banks. Our statement will now show assets, liabilities, cash $155,000, capital $100,000, due from other banks, $20,000, deposits $75,000, $175,000, $175,000. During the early history of the bank, connection will have been established with one or more metropolitan banks, and a deposit balance created. The primary reasons for the maintenance of balances on D. The nature of commercial banking. 15. Posit with banks and centers to which the locality of a given bank is commercially tributary are, 1. That the local bank may be able to sell drafts on those centers for the accommodation of its customers who may desire to remit drafts as means of payment, and 2. That the local bank may have agents in the centers to handle and collect drafts drawn by dealers or manufacturers who have shipped goods to distant markets, and 3. That the local bank may have collection agencies for the stream of checks deposited daily by its customers. It would be reasonable for a bank having a capital of $100,000 to place $25,000, more or less, on deposit with one or more banks in commercial and financial centers to which the locality of the bank with which we are concerned is tributary. Cash would then be reduced. $25,000 and due from banks would be increased to $45,000. The statement would stand: assets, liabilities, cash $130,000, capital $100,000, due from other banks, $45,000, deposits $75,000, $175,000, $175,000. Applications for loans amounting to $20,000 are received and approved. The average time is 90 days. And the rate 6%, the discount amounting to $300. The proceeds, $19,700, are left on deposit to be drawn against by check. This lending transaction introduces into the statement some new items. Loans and discounts, being valuable instruments in the possession of the bank, will take a place on the asset side. 16. Bank credit. Of the statement, deposits will be increased by the amount of the proceeds of the loans, the discount, which is profit undivided and belonging to the shareholders, will be recorded as a liability under the head of undivided profits. Assets and liabilities have grown to the following proportions: liabilities, capital $100,000, undivided profits $300, deposits $94,700, $195,000, loans and discounts $20,000. Due from other banks. $45,000. Cash $130,000. $195,000. The directors of our bank feel that the amount of cash lying idle in the vault is unduly large and vote to buy $30,000 worth of bonds and, confident of the future, also vote to invest $5,000 in a well-located vacant lot on which, in the fullness of time, to erect a new banking house. The purchase of the bonds and real estate for cash is now reflected in the balance sheet. Assets. Loans and discounts. $20,000. Due from other banks. $45,000. Real estate $5,000. Bonds $30,000. Cash $95,000. $195,000. Liabilities. Capital $100,000. Undivided profits $300. Deposits $94,700. $195,000. An overdraft, which occurs when the bank allows an unbusinesslike customer to draw upon the bank for the nature of commercial banking. 17. A sum in excess of his balance is a form of loan, an asset, but generally bears no interest. Short end. Company having a deposit balance of $200 at the bank. Send a check for $210 to a New York wholesaler in order to pay an overdue bill. The check is deposited by the wholesaler in a New York bank, passes through the clearinghouse to the New York correspondent of the local bank, and then to the local bank itself on which it is drawn. The procedure makes several changes in the balance sheet. Deposits are reduced. $200, i.e., short, and company's balance is entirety wiped out. An overdraft of $10, a negative deposit, expressed in red ink on the individual ledger, is created. Due from banks is reduced $210. The bank has made no profit on the transaction, but the balance sheet presents an entirely new item. Overdrafts. Assets. Liabilities. Loans and discounts. $20,000. Capital $100,000. Overdrafts 10. Undivided profits $300. Due from other banks. $44,790. Deposits $94,500. Real estate $5,000. Bonds $30,000. Cash $95,000. $194,800. $194,800. A traveling representative of a commercial paper house visits the bank, which buys, after investigation, one note of $2,500 each of 4 such open market borrowers as the International Harvester Company and the Goodyear Tire and Rubber Company. The 18 bank credit. Average time of the paper bought is 4 months, the rate 6% and the discount $200. New York and Chicago drafts, drawn for a total of $9,800, are given in payment. Without reproducing the statement of the bank, we may indicate the changes which the purchase of the paper in the open market entailed. Undivided profits are increased $200, loans and discounts by $10,000. Due from other banks is reduced $9,800. A farmer J, in order to add to his acreage, borrows $5,000 from the bank, giving a mortgage on real estate as security. The time is 5 years and interest at 6% is made payable annually but not in advance. The amount of the loan is taken by the borrower in cash and paid to the seller of the land, who deposits it in a bank in a neighboring town. Cash is reduced $5,000 by this transaction. Loans and discounts increased by $5,000. Another customer of the bank pledges stock in a